On today's news, hi guys, welcome to the second part of what should we call it?
Our series.
I'm holding your hand through the home buying process. So today I have some little notes here so that are like bullet points so that I can stay on track. But today I wanted to go over what's next. So in the first video we talked about getting pre-qualified and a couple definitions and scenarios, and so now we're going to go over what happens next, or which is kind of like an interim period between getting an offer accepted and getting pre-approved. And so it's kind of the time frame where you communicate with your realtor and there might be some back and forth. So the first thing here that I notated is the pre-approval. So congratulations, you've been pre-approved and we're excited and we're ready to look at homes. The way I work it is I set you up on an auto prospecting system that will automatically email you anytime a home goes on the market and is listed on our Metro List system, which is a website that all realtors put up their houses for sale on. And so that way you're notified immediately as soon as the house comes on the market, and you don't have to wait until you find one. I'm automatically sending you these homes that meet your criteria. So I will go over what is your criteria. I will go over if your criteria is doable based on your pre-approval amount, because we are running into a lot of higher priced homes. And so sometimes, which kind of brings me to the next point, which is common misconceptions. And one of the biggest ones I think lately is monthly payment, because there's multiple sources of ways that you can come up with the monthly payment. But unfortunately, some of these websites aren't accurate, or they're not fully detailed, or maybe you're not fully educated in what all is included in the monthly payment. So there's websites like Zillow and realtor.com, and you can just Google mortgage calculator, and what they're going to go over is the monthly payment, principal, and interest. So if you are a first-time buyer, most likely your monthly payment is going to be composed of 5 different items. And so the first one is going to be principal and interest. So a big portion of your monthly payment is going to consist of principal and interest, how much of your payment goes towards the balance owed, which is principal, and then interest, how much you pay to the bank. And the second one is property taxes. So you have to pay property taxes to the county, but most of the time, if you're a first-time buyer, they're included in your monthly payment, and your mortgage company collects them from you, and then they pay them when they're due. And so for our county, that's 1.25% of the price. And then the third one is homeowners insurance, which is also known as hazard insurance. So this is where the home is covered in the event of liability purposes, if someone was to hurt themselves in your home, as well as if things are stolen from your home, like your personal belongings. And there's different coverages that you can go over with your insurance agent, and they'll customize this insurance quote for you. Number 4, which is mortgage insurance. So most people think that they don't have to pay this insurance because it's a benefit for the lender, but it's not optional. If you are not putting 20% or more down, then you're going to have to pay mortgage insurance. Mortgage insurance is, depending on your loan, it's either going to be 0.85% of the price, or if you're getting a conventional loan, those mortgage insurance percentages vary. They could be as low as like 0.5% if you have really good credit. But mortgage insurance is a guarantee to the bank that even though you stop making your mortgage payments, this mortgage insurance is going to cover them the balance owed. And so that doesn't mean that you still get to keep your house. Even if you stop making your payments, you still have to pay your mortgage payments. They can still foreclose on you, but they're still covered. So they're still covered the balance you owe them, and they get to get the house if you stop making your payments. So it was actually 4 components: principal and interest, property taxes, homeowners insurance, which is also known as hazard insurance, and then mortgage insurance. So all of those added up is what your total payment is broken down to. So yeah, so that's what I wanted to go over, because we always run into the scenario where you go online and it's $500,000 house, and it tells you online that it's $1,800 a month, and that's not the case. So it's more like $3,000 a month if you're putting. You also have to be aware of what percentage you're putting, and a lot of this process is trust. You have to trust who you're working with. You have to trust that the numbers they're giving you is they know what they're doing. The lender knows what they're doing, and your realtor knows what she's doing. But it's okay to question, and we'll just work through it. But that's, sometimes there's a misconception with what the payment is and how come I come up with a lower one. I guess I'll go over the different types of loans first. So the different types of loans, which I kind of went over a little bit, the most commonly used are 3, which is an FHA loan. An FHA loan is for someone that has a minimum down, a very low down payment to give, and also has maybe not as good credit score. So they only have to put a 3.5% down, and their credit score can be as low as 620. I've heard of 580 in some instances. But you can purchase a home, and then later you can refinance and get out of the FHA loan. Some reasons why people get out of an FHA loan is to remove that mortgage insurance that I was going over, because the good news is that mortgage insurance can be removed eventually once your home value goes up 20% or you drop your balance 20%. And ways to get your home value to go up is by remodeling it, adding on and making the square footage bigger, or just over time. Most people within 2 years, their home value has already gone up 20% in our current state of the market, some even in a year. But those are FHA is one of the most commonly used, and the monthly insurance, the mortgage insurance part of the monthly payment is 0.85%, and then there's also an upfront cost for FHA mortgage insurance. The second one mostly used is a conventional loan, and that a conventional loan is a little more lenient with the condition of the home, and it is preferred by sellers when they get conventional offers, because there is this, I don't know if it's a misconception, but a lot of lenders do say it's a misconception that sellers think that conventional appraisers give higher value than for properties than FHA appraisers do. So it's I don't know if it's real or not. I don't know. I don't want to commit to saying that it's a misconception, but that is something that sellers do look at, what type of financing the buyer is getting when they submit their offer, and if it's a conventional offer, they do prefer over FHA offers. Unfortunately, that is true. And so the condition of the home with conventional doesn't have to be as good as with FHA. And also with conventional, if you have a really good credit score, you get a lower monthly mortgage insurance, and you can buy with as little as 3% down. But most of the time, if you have a low credit score, like below 680, they don't recommend going conventional unless you're putting over 20% down. And then lastly is VA loans, which is a veteran loan. It is 100% financing, but you do have to pay your own closing costs, and the property does have to pass section 1 and 2 of the termite inspection, which the termite inspection doesn't just check for, which is called pest inspection actually. but people know it more as a termite inspection, but it's a pest inspection. And they don't just check for termites, they also check for dry rot on the exterior of the home, for fungus, and sometimes they even check for, for plumbing leaks, and a couple other things, but it's not as in-depth as a full-blown general home inspection. So those are the three most commonly used loans. There are USDA loans for rural areas. There are private lender loans or hard money loans. But I'll just go over those three. Some of the terminology I wanted to go over and just explain the differences is between mortgage insurance, which I think I already went over that pretty good. I hope you guys are on pace with me. And then so mortgage insurance, and then homeowners insurance, and then there's also a home warranty. So the homeowners insurance covers the property against, like I said, liability wise if someone was to get injured in your home. It also covers, some unexpected, like disaster to happen. Like my brother's house got flooded over a toilet leak upstairs, and so they covered that and all the repairs that had to do with that. And if your items get stolen from your house, then they cover you for that as well. But home warranty only covers, they don't cover all of what homeowners insurance covers. A home warranty covers things like your heating, your air, electricity, plumbing. You can add on additional coverages like roof leak, appliances, and the home warranties are usually for 1 year. And there are other you can pay extra for 2 years, but the standard is 1 year coverage. Those run about $550 with the company that we use is First American, and you can add on more items, and it'll, whatever you add on costs more, but we do provide our clients with the pamphlet, and our representative at First American is open to speaking to our buyers so that they can make sure they get, all the coverages that they might want. There's also for people that purchase in the outskirts, septic coverage, and well coverage. So that's pretty good. I think that's pretty much it for this video, guys. The next thing that we will be going over is once you get in a contract, once you get an offer accepted, and what are the steps after that. But I hope I cleared up some of your questions, and I hope you find value in these, and you share them, and you follow us, and give us your feedback, good or bad. I don't get butthurt. And thanks, guys. Have a good one.